Most people think mutual funds are risky, but the truth is different. Mutual funds don't create losses, wrong decisions do. Two people invest in the same market. One builds wealth, one stays stuck for years. Same economy, same opportunities, different outcomes. Why? Because one follows a system and the other follows noise. They chase top-performing funds. They panic during market falls. They exit at the worst time. And slowly, they lose confidence. But there is another way, a calm, structured, disciplined way, where you don't depend on luck or predictions. You follow a process that works across years. In this video, you will learn that exact system. Simple steps, clear thinking, no confusion. So you can choose the right mutual fund and stay confident, even when markets move. This video is for educational purposes only. I am not a SEBI-registered investment advisor. This is knowledge, not personal financial advice. Markets carry risk. Returns are not guaranteed. Do your own research. Consult a certified professional if needed. Your money, your responsibility. Define your goal clearly. Not vaguely, not emotionally. Be specific. What do you want and when do you want it? A car in 3 years? A house in 7 years? Retirement in 25 years? Each goal has a timeline, and timeline decides risk. Short-term goal needs safety. Long-term goal can handle volatility. Example, you need 5 lakh rupees in 3 years. Avoid equity-heavy funds. But if you want 50 lakh rupees in 15 years, equity becomes necessary. Without a goal, every fund looks confusing. With a goal, decision becomes simple. Build asset allocation. This is your foundation. Not returns, not brand names. Allocation. Divide your money. Equity for growth, debt for stability, gold for protection. Each has a role. Example, you invest 20,000 rupees monthly, 12,000 rupees in equity, 6,000 rupees in debt, 2,000 rupees in gold. This creates balance. If equity falls, debt supports. If inflation rises, gold protects. Do not depend on one asset. Diversification reduces stress and improves survival. Choose the right category, not the trending fund. Categories decide behavior. Large-cap funds, stable companies, lower volatility. Mid-cap funds, growing companies, moderate risk. Small-cap funds, emerging companies, high risk. Index funds, follow market, low cost. Hybrid funds, mix of equity and debt. Example, if you're a beginner, start with large-cap or index fund. If you can take risk, add mid-cap slowly. Do not jump directly to small-cap. That is where most beginners fail. Understand SIP deeply. SIP is your strongest tool, not because of returns, but because of discipline. Systematic investment plan means fixed investing every month. Example, 10,000 rupees every month for 15 years. Total investment, 18 lakh rupees. With 12% average return, it can grow beyond 50 lakh rupees. This is compounding. SIP removes timing pressure. Market up, you invest. Market down, you still invest. This builds consistency. Do not stop SIP and panic. That breaks the system. Evaluate risk properly. Return is visible. Risk is hidden. Understand drawdowns. If a fund falls 30%, will you stay invested? If answer is no, that fund is wrong. Look at consistency. Not just 1 year return. Check 5-year journey. Smooth growth is better than sharp spikes. Choose peace over excitement. Respect market cycles. Markets are not linear. They move in phases. Bull phase, everything rises. Bear phase, everything falls. Sideways phase, nothing excites. Every fund struggles sometimes. Do not expect constant winners. If your fund underperforms, check reason, not react immediately. Patience is part of strategy. Expense ratio awareness. Costs reduce returns silently. Even 1% difference matters. Example, 10 lakhs invested. For 20 years, higher cost fund can reduce lakhs in returns. Direct plans have lower cost. Index funds are cheapest. Less cost, more wealth retained. Rebalance regularly. Portfolio changes over time, not because you act, but because markets move. Example, start 70% equity, 30% debt. After rally, equity becomes 80%. Risk increases. Rebalance. Bring it back to 70-30. Sell excess, buy underweighted. This locks gains, controls downside. Do this once a year. Basic tax awareness. Tax impacts real return. Equity funds above 1 year, 10% tax on gains above 1 lakh. Short-term, 15% tax. Debt funds taxed as per slab. ELSS funds tax saving option. 3-year lock-in. Choose wisely, not blindly. Avoid common mistakes. Too many funds creates confusion. Chasing past returns leads to disappointment. Stopping SIP breaks compounding. Investing without a plan leads to chaos. Keep it simple. 2 to 4 funds are enough. Focus beats variety. Scaling your investment. Income increases over time. Your SIP should too. Start small, 3,000, 5,000. Then increase yearly, 10,000, 15,000. This creates exponential growth, not overnight, but steadily. Think long-term. Wealth is not built quickly. It grows slowly. 5 years builds habit. 10 years builds momentum. 20 years builds freedom. Compounding needs time. Do not interrupt it. Control emotions. The market will test you. Fear in crashes, greed in rallies. Both are dangerous. Your advantage is discipline. Follow your plan. Ignore noise. Consistency wins. Review, not react. Check portfolio once or twice a year, not daily. Daily tracking creates anxiety. Review with logic, not emotion. Make changes slowly, not impulsively. Stay simple, stay strong. You don't need complexity. You need clarity. Simple strategy, executed consistently, always wins. You don't need to predict markets. You need to prepare. You don't need perfect funds. You need consistent action. Your wealth will not come from one decision. It will come from hundreds of small, disciplined steps. Stay calm, stay invested, stay focused. One day, you will realize the system worked, and your future self will quietly thank you.